Level 1. The Contrarian. You are 27 years old, and you have just published a research report saying a company worth $4 billion is actually worth nothing. You did not say this carelessly. You spent 4 months building the case. You have 67 pages of analysis, 3 years of financial statements marked up in red, 11 source interviews, 2 independent forensic accountants who reviewed your methodology and found no errors. The CEO is going on television tomorrow morning to call you a criminal. You are correct about the company. That will not protect you from what comes next. But it started much earlier than that. You are 24 years old, and you were sitting in an equity research department at a mid-sized asset manager, trying to understand why a company's revenue keeps growing while its cash conversion keeps declining. Everyone else in the building is long the stock. The analyst coverage is uniformly positive. The price target keeps getting raised. The company keeps beating earnings. And yet, every time you look at the cash flow statement, something is wrong in a way you cannot immediately name. You spend 3 weeks trying to name it. You build a model that strips out the non-cash revenue recognition items. You call 2 former employees. One of them hangs up immediately. The other one talks for 40 minutes and says nothing on the record, but confirms enough off the record that you know you are not imagining what you see in the statements. You write a 14-page internal memo. Your portfolio manager reads it. He says it is interesting. He does not act on it. The stock goes up another 18% over the next 6 months. Level 2. The research. You are 26 years old and you have left the asset manager. You are now at a small, short-focused hedge fund with $400 million under management. 8 people in a single open-plan office in Midtown. No art on the walls. No standing desks. 3 Bloomberg terminals and a whiteboard covered in names and question marks. The fund's entire philosophy is simple and difficult in equal measure. Find companies where the story and the market believes does not match the financial reality underneath it. Then short the stock. Then wait. Waiting is the job nobody tells you about. Your first assignment is a healthcare company, a diagnostics business. Revenue growing at 34% per year for the last 4 consecutive years. The stock has tripled. Wall Street analysts have 12 buy ratings on it and 1 hold. You were asked to figure out whether the growth is real. You spend 6 weeks on it. You request 10 years of Medicare billing records through a Freedom of Information Act filing. You hire a specialist physician to review the company's test reimbursement codes. You visit 3 clinic locations in different states, posing as a potential referral partner. You build a revenue model from the ground up using independent data on test volumes, reimbursement rates, and patient demographics that has no relationship to the numbers the company reports. Your model says their real revenue is approximately 40% lower than what they're reporting to the market. You sit with that number for 2 days before you show it to anyone. Not because you doubt it, because you understand what it means. If you were right, this is not a badly run company. This is a fraud. And publishing that conclusion puts you in a different category of risk than publishing a bearish view on an overvalued stock. You show it to your portfolio manager on a Thursday morning. He looks at it for 20 minutes without speaking. Then he says, "Find one more data point that is completely independent of everything else you've built. Something that cannot be explained away." You find it 5 days later. A procurement database showing the company's supply orders for the chemical reagents required to run their diagnostic tests. The quantities ordered are consistent with running approximately 3.2 million tests per year. The company is reporting revenue consistent with 5.7 million tests per year. The gap is 2.5 million tests. The tests do not exist. The fund builds a short position worth $180 million. Level 3. The report. You are 27 years old, and you have spent the last 3 weeks writing the most important document of your career. 67 pages. An executive summary that states the conclusion plainly in the first paragraph. This company is a fraud. The stock is worth 0, and the evidence is as follows. Then 40 pages of evidence. Then 17 pages of methodology and sourcing. Then a legal review by 2 outside attorneys who spent a week looking for anything that could expose the fund to liability before publication. The night before publication, you sit at your desk at 11 p.m. in an office that has been empty for 3 hours. Everyone else has gone home. The report is final. The legal team has signed off. The position is in place. Tomorrow morning at 7 a.m., it goes to every major financial journalist, every SEC Enforcement Division contact your fund has, and public simultaneously. You have checked every number in the report 4 times. You have reread every source interview transcript. You have gone back through the procurement data 3 separate times, looking for an explanation that doesn't involve fraud, and found none. And yet, you sit there in the silence of the empty office, asking yourself the question that every short seller asks at this moment. What if I miss something? Not a small something, a structural thing, a piece of context that changes the interpretation of everything else. A legitimate explanation for the test volume gap that you somehow failed to find in 6 weeks of research. You go through the list of possible explanations one more time. Contract manufacturing, bulk ordering, testing methodology changes. You have checked all of them. None of them close the gap. The thesis is right. The market doesn't know yet. You turn off your monitor at 11:47 p.m. You take the elevator down. You stand outside on the street for a moment in the October cold. Then you go home. Level 4. The publication. The report goes out at 7 a.m. on a Tuesday. By 7:14 a.m., the stock is down 22%. By 7:31 a.m., the company had issued a statement calling the report false, defamatory, and the product of a criminal short and distort scheme designed to manipulate markets for profit. They announced they are retaining legal counsel and will pursue all available remedies. By 7:45 a.m., the CEO is live on financial television calling you specifically by name a criminal. He is calm, professional. He speaks with the authority of a man who has given 200 investor presentations and knows how to perform certainty. He says the company's growth is real, the methodology is sound, the procurement data has been misinterpreted, and the short seller's motives are entirely financial. He says the SEC should investigate the fund, not the company. Your phone rings 41 times between 7 a.m. and 9 a.m. You answer none of them. By 10 a.m., the stock had recovered 14% of the initial drop. Retail investors are buying the dip. Financial forums are full of posts calling your fund parasites, frauds, market manipulators. 3 separate crowdfunding campaigns to short squeeze your position have been organized. A website has been set up with your name and photograph and the word fraud in red letters. Your fund is up $39 million on the position. Level 5. The squeeze. You are still 27 years old, but the 6 weeks that follow will age you in ways that do not show on the outside. The company's management team goes on a 22-city investor roadshow. They do not address the procurement data. They show new customer testimonials. They announce an accelerated share buyback program worth $200 million. They announce a partnership with a major hospital system. They announce a dividend. Every announcement sends the stock up 3%, 4%, 6%. Every uptick costs your fund $6 million, $8 million, $12 million on the open short position. This is the part they do not teach in finance classes. Being right about the fundamentals and losing money are not mutually exclusive. The market does not have a deadline for being rational. It can stay irrational for longer than you can stay solvent. And the company's management team knows this and is using it deliberately. Every announcement is not a business decision. It is a weapon. At week 4, your fund is down $140 million on the position. You are still right about every number in the report. The procurement data has not changed. The test volume gap has not closed. The fraud has not stopped happening. Your portfolio manager calls a meeting. There are 8 people in the room. The position is reviewed. The data is reviewed. The legal exposure is reviewed. Nobody says the word capitulate, but it is present in the room in the way that unsaid things are present when everyone in the room is thinking the same thing. You walk through the thesis again. Every data point, every source, every independent verification. You find nothing that has changed. The thesis is intact. The market has not caught up yet. The fund holds the position. Level 6. The Vindication. Week 11. A different journalist publishes a story about a former employee of the company, a lab technician who kept records, internal records. The journalist has the documents. The story runs on a Thursday morning. The stock opens down 31% and does not recover. Trading is halted twice. By noon, the SEC has announced a formal investigation. By 3 p.m., 2 board members had resigned. By end of day, the company's outside auditors have withdrawn their audit opinions for the last 3 fiscal years. Your fund closes the position at the end of day. Net profit on the trade, $340 million. You sit in the same chair at the same desk where you sat at 11 p.m. the night before publication. The office is full now. People are moving. Numbers are being calculated. Your portfolio manager walks by and puts his hand briefly on your shoulder and keeps walking. That is the entire acknowledgement. You open a new spreadsheet. You have 3 other names in the queue. The process starts again. This is the vindication that people on the outside imagine as triumphant. It is not triumphant. It is quiet and clinical and almost immediately passed. You were right. The market confirmed it 11 weeks after you said it. The company is being investigated. Investors who held the stock lost $2.3 billion in market value. You were not thinking about any of that. You were thinking about the next name on the list. Level 7. The cost. You are 31 years old and you have published 7 major short reports in 4 years. 4 of them have been fully vindicated. 1 is still pending. 2 turned out to be wrong. Not frauds, just badly run companies that recovered and whose stocks went up after you shorted them. Those 2 cost the fund $180 million combined and cost you something harder to quantify. Your name is known now. Not broadly, specifically. In the specific community of people who pay attention to short-selling research, your name is associated with a particular kind of work, thorough, sourced, and occasionally devastating to the companies it targets. This reputation has 2 effects. The first effect is that people send you things, tips, documents, disgruntled employees who suspect something is wrong at a company and don't know what to do with what they know. Former auditors, former executives, people who have information and want someone to do something with it. Your inbox contains, at any given time, approximately 200 of these messages. Most of them are nothing. A few of them have been the beginning of something. The second effect is that companies now know your name before you publish. When you start researching a target, your FOIA requests get flagged. Your clinic visits get recognized more quickly. 2 companies in the last year have hired private investigators who followed you for periods of weeks. One company's legal team sent a cease and desist letter to your fund based on nothing. No report had been published, no statement made, simply because they had heard through a source that you were asking questions about them. This is the part that nobody outside the business understands. You are not a journalist. You are not a regulator. You are a private citizen running a legal investment strategy. Level 8. The Reckoning. You are 34 years old. The fund manages $1.2 billion. Your track record over 7 years is exceptional by any objective measure. Your net returns after fees are 19.4% annualized. Your Sharpe ratio is 1.3. You have been right more than you have been wrong, and right by a larger margin than you have been wrong. None of this has made you popular. 3 companies you have published reports on have sued the fund for defamation. All 3 cases have been dismissed. The legal fees over 7 years total $14 million. One of the lawsuits lasted 3 years and required your deposition on 11 separate occasions and the production of 340,000 documents. The company was subsequently found by the SEC to have been engaged in exactly the conduct your report described. The lawsuit was dropped the day the SEC consent order was announced. There was no apology. You have been called, in print, by named executives of public companies, a criminal, a parasite, a market manipulator, a terrorist, a coward, and on one occasion by a CEO on an earnings call, without naming you directly but in a way that was unmistakable to anyone who knew the context, a person of low moral character. A CEO can go on television and call you a criminal to an audience of millions. You can publish a 67-page research report, and it will be read in full by approximately 400 people. The market is your only equalizer. When the market confirms your thesis, the score becomes visible to everyone. Until then, you are a person with a position and a spreadsheet against a company with a communications department and a media strategy. You understood this intellectually before you started. You understand it differently now. Level 9. The firm. You are 38 years old. You run your own fund now. $800 million under management. 6 analysts. 1 trader. A legal team on retainer. An outside PR firm whose entire job is to respond to the communications campaigns that target companies run against you when a report is pending. You have refined the process over 12 years into something that is almost entirely systematic. Idea generation, deep research, independent verification, legal review, publication, position management. You have done this 23 times. You have been materially right 17 times. The 6 times you were wrong cost you $380 million and cost your investors a portion of returns they will never get back. You review each of them once a year, not as self-punishment, as a methodology. Each wrong call had a structural flaw in the research process that you have since corrected. The procurement database approach came from a wrong call where you trusted management's volume claims without independent verification. The physician survey methodology came from a wrong call where you misunderstood the reimbursement structure. You are a better researcher than you were at 27 because of the 6 times you were wrong. That is the only honest way to account for them. Your name is on the door of a fund that has returned 22.3% net annually for 7 years. Your investors include university endowments, family offices, and 1 sovereign wealth fund. They understand the strategy. They understand the legal risk. They understand that in any given year, the fund might be down 30% because a company you are short is being artificially supported by its own buyback program. They stay because long-term math works. The long-term math works because the companies you research are, in the end, what the financial statements say they are. Numbers do not lie. People lie about numbers. Your job is the distance between those two things. Somewhere in a different office, in a different building, a different person is pulling the same company's supplier invoices through a data service. They are comparing the numbers to the reported revenue. They are frowning at their screen. They have not told anyone yet. They are checking it again first. The process starts again. It always starts again.